And welcome everybody to another Smart Money Circle update. I'm Adam Sarhan. With me today is John Davi, who's the founder, CEO, and CIO of Astoria Advisors with approximately 1.4 billion in AUM. John, welcome to the show.
Thanks for having me, Adam.
So, John, I always like to begin. Can you tell us your story and how you got to where you are today, please?
Sure. You want the whole life cycle story, or you want just the story?
Anything you want to share?
Well, sure. I'll talk just about the professional career. Started in the late '90s. I was a research analyst in Merrill Lynch's Quantitative Derivative Research group. I spent a good 18 years between Morgan Stanley and Merrill Lynch doing research, content, portfolio construction. And then in 2017, I started Astoria Advisors. Here we are now, 6.5 years later, and we're managing 1.4 billion. Our focus is, quantitative macro asset allocation, exclusive for independent RIAs. We have a range of solutions ranging from, quantitative stock portfolios, ETF model portfolios. We became the sub-advisor for the Access Astoria Inflation Sensitive ETF, ticker PPI, about a year and a half ago. So we have, a couple different solutions of how we connect with advisors. We're known for serving as an outsourced CIO. Our research is published on a couple different venues, Seeking Alpha, ETF.com, go on CNBC, Bloomberg TV quite often. So we've got a range of solutions. We've got good people, 3 CFAs on staff. We've got 7 employees. We've never had any turnover in our firm's history, which I'm really proud of. That's a little bit about what we do.
I love that. So thank you for that. So let's talk about the investment strategy and how you view the world.
Sure. So I would say, our focus for, let's say, our strategic asset allocation portfolios is, we'll combine macro plus quantitative. I find some firms either do macro, some firms are just pure quantitative, but we like to say we're the intersection of the two. I think in an ideal world, like we're saying, okay, take a blank sheet of paper, identify where we are in the market cycle, where we're in the economic cycle, historically, what factors, sectors, countries, sectors have done well in that part of the cycle, build an ETF portfolio that kind of, tracks that view, use a little bit of alternatives in order to kind of dampen and soften our portfolio volatility. So that's kind of what we do in a nutshell. I mean, there's 50 different indicators we look at. We download them systematically. The investment committee meets every month. We look at our indicators, identify where we're in the cycle. We review our portfolio tilts. We know exactly every week what our tilts are, what our standard deviation is, what our overweights, underweights are at each sector. We have on our website, AstoriaAdvisors.com, a cycle indicator deck where we literally list each of our tilts, each of our indicators, how they're progressing. And, I think that's over time, past performance on indicative future results. But, we've been able to demonstrate that we've been able to participate in the market, during the upswings, protect some capital when the market goes, down because we are diversified, we have alternatives. So I think we've demonstrated some reasonable success, and I think that's why our investors, have been generally pretty happy over, long periods of time. So.
No, I love that. So you're quantitative with the global macro overlay. You said tilts. For people that are not familiar, can you please explain what that is?
Yeah, so we're benchmark oriented. We don't just take excessive risk. Like we will make sure that we are within a normal range, couple hundred basis points, let's say, of risk versus our benchmark in a particular sector, style, theme, factor. Currently right now, we think that, inflation is going to be stickier and higher for longer. We've had that view for a while. So we've been protecting our portfolios with, let's say, PPI, which is inflation ETF that we're the sub-advisor for. I think that's like a good indication of like we had this foresight 2.5 years ago. We built a solution in an SMA format. We work with Access Investments to kind of bring it to life. So that is, kind of a tilt in our portfolio per se. We'll have other tilts in the portfolio depending on the year. In the beginning of this year, it was like very much, the kind of defensive oriented portfolio construction. We've increased some of our risk as the recession, which most widely anticipated, predict a recession that hasn't happened yet. As the recession fears have come down, we've increased some of the risk in the portfolio, but that's been through other factors like international quality stocks, international dividend paying stocks. But it's a core satellite approach, right? We're strategic, we want to be benchmark oriented, but then use our overlay to kind of add a couple hundred basis points of outperformance, give or take, in any given year.
That's wonderful. So, do you offer solutions to individual investors as well, or only to financial advisors?
So yeah, we're an intermediary for other financial advisors. We don't go direct to the end investors. We're not financial advisors. We're not planners. All of our assets are, where we're working with other financial advisor, either physically managing the portfolios for them or giving them our portfolios and doing like model delivery.
Understood.
So that's different for some of our peers. I'll just make that point because some of our peers, they don't touch the money. They're not doing the portfolio construction. They're not doing the trading. They're just sending their models on TAMPs and then hoping to raise assets.
Yep.
Whereas we're, actually bolted underneath the RIA at the custodians and we're doing the physical trading for them.
Got it. And your PPI ETF, that's available for everybody, just for clarity's sake. Is that correct?
Yes.
Okay,
Correct.
excellent. So, if a financial advisor wants a solution, global macro and or quantitative and or help managing the portfolio with a lot of your input, they can come to you, they'd open up an account, you'd sub-advise it, and then you guys have a relationship, you'd handle the money management side, and then they can go out and do what they do best, is acquire new clients, build those relationships, so on and so forth. Is that correct?
Correct. Yep. That is essentially the value proposition that we offer, which is not different from like what you would get at like an SEI, an InvestNet. It's just that we think we're a lot cheaper. Like our goal would be like to be the vanguard in the TAM space where we can do it at a much more cost effective price point.
Yeah.
We also don't think that like at InvestNet you've got 10,000 solutions. I don't think you need 10,000 solutions. So we've got a core strategic asset allocation models. We've got quantitative stock portfolios. We've got you can come in. We've got quantitative stock portfolios. We have our ETF. So that's kind of there's enough solutions that we can offer people to kind of satisfy their demand.
I love that. So let's talk about risk management for a second, John. How do you handle risk and what mistakes do you see people make with respect to risk management?
I think for risk management, our goal is to like, include alternatives in the portfolio, ones that are inversely correlated. So sometimes we see portfolios where it's like high yield bonds, leverage credit, leverage loans, senior loans, real estate. Those have positive correlation with risk with equities, let's say. Whereas our alternatives, will be inversely correlated. So inversely or very low correlation. So we use a ticker BTAL, which is negative 70% correlated with the S&P. We've used gold in the past, which has very low correlation. Gold miners, merger arbitrage. So, we're looking for like 10-15% of our portfolios to be in these alternatives. I think as far as risk management, like going into last year, we kind of identified that we would have higher inflation, Fed that was, going to be raising interest rates. So, we owned a lot of short duration bonds. We had a lot of cash-like instruments. We were defensively positioned. We had PPI in our portfolio, then inflation ETF. And, that helped, right? That's a form of risk management. And we had, a very good year last year, in our SMA, portfolios. So, how did we catch this? I think it's looking at history, looking at data, looking at time series, reading research, doing our own research, looking at independent research. And, we were able to identify that we were going to have an issue. So,
I love
and
that.
honestly, Adam, even going into this year, if I showed you our year ahead outlook, we
Yeah.
weren't like, massively saying run for the hills. We said there were three things that were priced in this year. One, an economic recession, two, an earnings recession, and three, there was going to be like a 20% downturn in the S&P. That's just a draconian outcome because everyone was like run for the hills. So if you're
Yeah.
saying run for the hills, then you must mean you thought the S&P was going to fall, north of 20%. We thought that was very unlikely to happen. In fact, we said of those three things that were priced in, we thought maybe one of those three, would play out, but we doubt that like all three would actually play out. So
No, very smart. And you were 100% right. So very well done. So, John, let's talk
thanks.
a little bit about some timeless lessons you've learned along the way that you'd like to share with the audience, please.
For investing.
Anything, life, investing, leadership, business. I know, anywhere you want to go. We'll take it all with the please and thank you with a cherry on top.
Yeah, I mean, I think you got to be humble, right? The market can make you second guess, and you know, everyone's surprised the S&P's up, 15% this year, but who would have expected it? Who would expect Apple and Netflix, Google to be up as much as they are now? I think like you have to respect history. You have to actually know what happens in economic cycles. I think stick to your true north. That's a big thing for us. Like our true north is to be diversified across factors, using alternatives. I think once you stray away from that true north, you can get yourself in trouble. So that actually applies, I think, for general life, lessons too. Um, listen, as on a personal front, there's always going to be somebody smarter than you that can work, you know, faster, harder, but you have to stay in your lane and know what you want to do and want to be successful at. So we like to say that we're very good, content generators. That's where we want to like, really emphasize. People, some of our peers may have better returns, maybe they take more risk. But we're always going to be diligent with our portfolio construction, follow our research, publish good content. And I think that's kind of, you can translate that in the outside world.
Yeah, no, I love that. So let's talk about some timeless mistakes. What are some timeless mistakes you've learned along the way and that you'd like to share with? How do you avoid them?
Well, I think for investing, you have to be careful. Like there is when you're so sure of something that something will happen, there's the market will keep you humble and surprise you. So, again, we weren't as bearish going into this year, but we certainly didn't expect, a 15% rally in the S&P, and I certainly didn't expect, developed international markets to be up, 15% as well. So I think, just you have to like follow your models, but then keep an open eye and just, you just don't be closed-minded when it comes to like investing. Like have a process, follow it, but be open-minded.
Yeah, that's really, really powerful. So let's talk about adversity for a second. What are some obstacles that or adversity you faced over your life on or off Wall Street, and how do you overcome that? And what are some lessons that you've learned?
As an entrepreneur, startup company, you're going against the behemoths, the 800-pound gorillas, it's daunting, right? You've got to just stay focused, work hard, be open-minded. Um, you explained to me before about your business, and I hope to talk to you afterwards. But I think like, there's a lot of anything that like takes a long time and is successful, like nothing comes easy. You've got to put in the time and the effort. So,
Yeah,
there's that book, 10,000 hours, you got to put in 10,000 hours. So, I think like anything can be done if you just put your mind to it and you surround yourself with good, smart people, which I think we have at Astoria. So, yeah, I mean, that's been, it's been challenging, but it's very rewarding too.
yeah, I love
Be a
that.
startup in the asset management industry where it's like every day, some large asset managers taking in 5, 10, $20 billion, but what's your edge, right? What's your true north, and separate yourself. So these are things that I think have been like, overcoming adversity.
I love that. Now, what advice would you give your 20 or 30-year-old self?
I would say use technology, embrace computer programming. Um, you know, I think coding and programming is going to be like the equivalent of like speaking English. Like my parents immigrated from Italy. They
Right.
came here. They didn't really have an education. Didn't don't speak. They speak English now, but like I think coding and programming is going to be the equivalent of that. in the very near future. You'll still need humans and salespeople and whatnot, but you know, you don't want to get behind like the data, and you know, there's so much data being produced, and who can effectively process the data and, you know, make good insights. I think that could be very powerful.
No, I love that. That's really, really, really powerful. Final question for you today, John, is what's the best piece of advice you'd like to share with the audience?
For investing,
Anything, investing or life or true north, anywhere you want to go.
you know, we're at a period now where the S&P is being dominated by, you know, 7, 8 stocks and massive concentration risk. I know everyone thinks that Apple and Netflix and Google are going to keep going up. I've just seen periods of my career where these stocks, they don't, you know, they come down from earth and there's a new market leader. So, you know, just be open-minded, right? Like, you know, change, you know, you have to, like, there's different cycles and you have to like build your portfolios depending on where we are in the cycle. And I think the fact that people are crowding into those 7 stocks means that they're pretty bearish on the rest of the US market and probably the rest of the world. We meet with financial advisors all the time. We inherit portfolios. Like, nobody wants to own international stocks. Why? Like, they're cheaper, like they serve purpose in your portfolio. They add diversification benefits. So, you know, just be open-minded. Like, I think like that would be one thing I want to stick with on this webinar.
No, I love that. Well, that's really, really great advice. John, thank you so much. Everybody, you can go to AstoriaAdvisors.com, and hopefully, John, we'll have you on again soon.
Thanks so much, Adam.